Hi, everyone, and welcome to a conversation with Richard Sandor, sponsored by the Heller-Hurwicz Economics Institute. We're here today to celebrate something new that Richard has done. He's done many things in his life. He's a great friend of the university, and one of the things which is great from our point of view is he's a famous alum. He's got his PhD in economics here in 1967. The topic was firm size and economies of scale and R&D. His first job, I think, was at UC Berkeley. And he left that after a few years to move to Chicago, where he became known as the father of financial futures, working at the Merck,
Board of Trade.
Board of Trade, okay. And he's spent many years there working on developing new financial derivatives and futures markets. That wasn't enough. Starting those markets wasn't enough. He had to go further and start a new creative venture where he set up markets for the trade of climate futures. The first version of that was the Chicago Climate Exchange. The second version was the European Climate Exchange. And the third version was the futures market version of that, if I'm correct. In 2007, I think, he was named one of Time's Heroes of the Environment. And now he's kind of relaxing. I guess by writing a book and teaching classes at University of Peking and University of Chicago. So we're pleased to have him here today to talk about his new book, Good Derivatives. I have a special copy because our economics department librarian won't let anybody touch dust jackets. And we had to get Richard to sign it for us. And he's going to talk about the book. And also here to help him talk about the book is distinguished professor in our department, the Paul Frenzel Land-Grant Professor of Economics, V.V. Chari. And he's also a very distinguished fellow, the author of over 60 scholarly articles, and he's the current director of the Heller-Hurwicz Institute. So with that, I think the format is they're going to talk a bit, then Chari's going to probably talk because Chari loves to talk. And then we're going to take audience questions. And if you want to ask an audience question, they're recording everything. You could probably subscribe to the iPod version of this someplace. But you have to ask your question into the microphone so that we make sure we get them all.
Thanks, Larry, for that. Is this working? I'm not sure if it is. It's not. It's working. All right, great. So the last 10 days or so, I've had a lot of traveling to do, but it's been much less painful than the usual amount of traveling because it's been a lot of fun reading Richard's book. So before we start talking about questions and all that, let me say something about the book. First thing you should know about the book is it's just marvelously easy reading, written in an extraordinary conversational style. It's part autobiography, part treatise on derivatives markets, part a manual for how you operate futures markets and derivatives markets. And so all of us have had the pain of reading operating manuals, or at least flipping through it, and we know how painful that can be. And this is the exact opposite of that. So it was just a lot of fun to read about this. And one of the things that I guess I learned in the whole process is, so as Larry mentioned, Richard's dissertation was on innovative activity, on inventive activity, written under the supervision of one of the great giants of Minnesota economics, Jacob Schmuckler. And so most of us write dissertations on inventive activity by others. What Richard decided to do with his life is to go ahead and invent a whole bunch of financial products. That's extraordinary. Let me start by asking Richard some questions, and then we'll get a chance for all of you to ask questions. So I was carrying this book around, and a good friend of mine looked at the title of the book and said, "Good derivatives, isn't that an oxymoron?" and so I guess the first question in that spirit is, in your judgment, what derivatives do you think are good? What makes them good? And in particular, what derivatives are bad, if any?
I think the question of a good derivative, it's very important to understand that during the meltdown of 2007-8, the Chicago model of a regulated exchange that's centrally cleared and truly transparent spread around the world. And there are now 78 derivatives exchanges in 36 countries. And what most people don't know is, or don't focus on, is there wasn't one systemic problem. It's trillions of dollars that are traded daily, no counterparty risk, no systemic risk, and they function perfectly. And no exchange got into trouble, no TARP money for any of the exchanges, no financial bailouts. And so those are good derivatives. They extend, and I think if we look at what has happened, is the growth of these has been something near phenomenal. We traded 13 million contracts in 1970, and it was up to 21.3 billion 40 years later. That's a compound growth rate, Chari, of 18+%. It's, if you take a look and consider what's happened there, and if we have some of the slides, you might want to throw up that one on growth if we can, and that's slide 12. And these have been extended to France, England, China, India, basically all over the world. It's chart 12 if we can. Less than 12. There you go. 12. Keep going back. Well, yeah, that one you just had. You know, and it was all confined to the United States. It spread worldwide. The exchanges themselves, if you just hop forward a little, you can see if you would have sat in 1970 and said, what's going to grow more, the airline business or commodity exchanges, there's nobody would have said, or the number of automobiles in the world over the next 40 years. You would have never put it in volume. Well, volumetrics is just one way. If we go forward another slide, I think we'll see something interesting. It's now spread with Europe, North America, and actually the biggest derivatives markets are now in Asia. They have surpassed the United States as the leader in developing these wonderful central marketplaces, and they are, in fact, expanding more than anybody else. If you go one step further and take a look at the market capitalization of the airlines, it's $32 billion. Even if you, 23 billion, even if you put American Airlines back, this is cheating a little because it's got American at its bankruptcy value, but let's say it reemerges at something like the larger ones. It's 7 billion, call it 30 billion. Now, that's the cost we know as economists. That's not necessarily the value of the markets. It's just the cost of replicating, right? It's the marginal cost of creating. If you take a look at the market cap of exchanges in the U.S. alone, go to the next one if we can, it's 31 billion. So the exchanges have a bigger market cap than the top 5 airlines, which I think a lot of people don't understand. And that's critical. Chari, the other part to the question is, what's a bad derivative? Maybe we could go forward and let me talk about an over-the-counter market that is a commodity, collateralized default swaps. And if we could move on to the next slide. Oops. I'll give you the number in 1 second. It's number 8.
That'll be 7, I think.
Yeah, I'll try to stick close to the order. Here you go. So, 4 or 5 years ago, the cost of buying insurance against a default of Greece was 27 basis points. Since 1828, Greece has defaulted every 2 years. Okay, so it is a little peculiar, not that the market would be wrong, but the fact that somebody wouldn't collect collateral against a 50% event that you charge 0.25%, and there was no margining system or collateral for those who wrote insurance against the Greek default. And we all know that that's what brought AIG down, was the uncollateralized CDS portfolio they had. And so we have, and if we take a look at real estate, where we regularly have 5, 10, 20% contractions in the 80s and 90s, and most recently 20% or more in the recent years, the community in finance seems to consistently underestimate the risk of sovereign defaults and real estate. I don't know why, but those seem to be where we have persistent credit issues and persistent breakdown of financial instruments. So I guess and I'll talk and close where I think the next major economic disaster is going to come, just from a common sense.
We'll wait so that people have a chance to run out and sell whichever industry short they can at that time. I wanted to go into a little bit more detail, then we'll come back to the broader issue. So what I take from what you just said is good derivatives are derivatives that are traded in centralized markets that minimize counterparty risk. Those kinds of products of necessity also have to be fairly standardized. Now, if I were a defender of the over-the-counter market, I'm not, but if I were, their defense typically is that that market is necessarily opaque because I have to tailor the contract to the specific characteristics associated with the kind of derivative that I'm trying to create.
That's true, but not as heterogeneous as we think. So one of these conditions that I was speaking about of a central counterparty, of exchange traded, of homogeneity, are sufficient conditions. There are other markets, such as those for interest rate swaps, which is an over-the-counter market in which you guarantee interest rates. Banks use them frequently, corporations, and they are tailored to the needs of the issuer. So if the bond is, reset or callable or has certain provisions on it with regard to timing, when the dividend is paid or when the coupon's paid, the swaps are tailored, but that market functioned flawlessly, Chari, and I think in that case there was a OTC group called ISDA, the International Swap Dealers Association. They standardized it except for 5 or 6 terms that could be tailored. The same with the foreign exchange markets, that these markets work very well, and they are reasonably or pretty transparent. While you don't know the counterparty, you can go to any number of brokers and there's an online bid or offer for an interest rate swap, and you can modify that standard one to say, well, I'll add 2 or 3 basis points because it's a different date or it's 2 years longer. So the issue that really comes up is how homogeneous is the commodity? In my humble opinion, does it fit a real bona fide risk transfer need? And if it fits that risk transfer need, it is functioned as a good derivative in the classic sense. Some of the derivatives didn't fit that category. And they were quite opaque, and you didn't know what the bid-offer spread was, and it could have been a very significant percentage of the cost of buying the insurance and changes the dynamics of it. And this is the difficulty.
Right, so one of the things that I was struck by, this is about inventive activity, is a lot of the products that you and people working with you created were exceptionally successful. But it reminded me a little bit of, reading your book, reminded me a little bit of looking at a venture capitalist portfolio. You take as given that, I don't know, 80%, 90% of the firms you invest in, the products you develop are going to fail, and a smaller number are going to succeed, but they're going to do very well. So I was trying to you provide some understanding of what is it about the kinds of products that you introduced that were successful, and what made the products that you tried to introduce unsuccessful. So one of the issues there, and this shows up repeatedly, is that brokers and others who are engaged in traditional markets often resist the introduction of transparent trading in open outcry types of markets or electronic markets, right? So was it vested interests? Was it something about contract design? Was it something about the institutional structure? Was it something about legal issues? What do you think were the important lessons you learned from failure?
Well, the first thing is, and Chari, you hit it, and I do owe so much to Minnesota, because when I worked with Professor Schmuckler, you know, I kind of, at that time, it was 64, and this famous article had come out by Harry Markowitz, and I had said to Professor Schmuckler, really, this is no different than investing in a portfolio of stocks, and that R&D could be looked at as projects which had different means and different variances, you know, and expected values, and some have a very high probability of success with a very little value added. Some have a very low probability of a success with a very high value added. So I was often guided by, number one, did our team think that we would anticipate volatility and therefore the need to transfer risk? Right, that's really a question. So in 1969, I was teaching at Berkeley, and we had a housing problem in California. California was like an undeveloped country in the 1960s. The S&Ls had to pay a premium of 1% to the savings banks in the Northeast to attract capital to feed a growing housing market. And there was a credit crunch, a mini one in 66 and another one in 69. And I said, geez, I wondered to myself, started to trade commodities for my own account. I had done very well trading equities, and I mistakenly thought it had to do with my good sensibility as a speculator and investor. It was a bull market, and living And then moonlighting at Stanford, you couldn't help but pick a winner, you know, and I mistook that for intelligence. And so somebody said to me, why don't you trade commodities? So I became very keen on it, and I said, geez, interest rates could be a commodity. And I took a sabbatical after 6 years on the faculty, 5 years, and to become chief economist of the Chicago Board of Trade. And I didn't want to leave. I thought I'd never go back or live in Chicago. We were very happy, 2 kids. My wife was an artist. It was Berkeley in the 60s. Well, you can imagine walking into a Wall Street bank and saying, hi, I'm a University of California faculty member. I work for a commodity exchange, and I'm here to narrow your profits. The look was essentially, why don't you go back to Berkeley and smoke dope? And so the notion was frequently pointed out to me that interest rates don't fluctuate, and therefore there's no need to hedge. Okay, this was the big thing. Second of all, you can imagine the monopoly that the investment banks and commercial banks had, and an opaque market. You could borrow at one rate, lend at another rate. You had no clue what those were. The bid-offer spread in Ginnie Mae mortgages was $2. Okay, what that means, it was 98 bid at par offered. Okay, so you'd pay 2% to the principal just for making a market. And so we tooled away, and how do you know you're okay? You really have a good idea if everybody loves it or everybody hates it. You know, it really has to be viable. And so we thought we were on the right track because all of the vested interests didn't like it. The investment banks didn't want to see transparency. The commercial banks, they dealt in Eurodollars. The bid-ask spread at that point, they were traded in eighths. So you could borrow, it would be 4 5/8 at 4.5. That's 12 basis points. And when you do trillions of dollars, that spread is down to a quarter of a basis point or a full basis point at most. And that's a pretty big franchise. If you take a look at the Ginnie Mae market, when we started the futures, the bid-offer spread on the current coupon was a half a point, 3/4 of a point. It was as wide as 2 points. And if you take that and go through the life of a typical mortgage, American house, $250,000 or that nation, the difference in interest payments is roughly $6,000. That's a lot of profit, you know, to be then divvied up between not the intermediary, but the lender and the borrower. You know, a lot of room for Pareto types of movements. So I think one is look for markets where you anticipate volatility. Number 2, see if you can cleverly design and turn it into a heterogeneous item into a homogeneous item. And make sure then that you have a broad range of institutional capability. And in my case, it was always the touchstone of the academic world. And what I learned here at Minnesota, try to engage the economics profession to look at things from an unbiased point of view, and because it would be very hard for vested interests, if not impossible, to really influence academic thought. So And the last thing is these are products that take 10, 20 years. And you got to, our first draft of the contract was submitted or dreamt up in '69. We went through 23 iterations before we got a final draft. I mean, there's a great pre-sulfa drug called Salvicin 606. It was invented by a German physician by the name of Ehrlich. And it was the cure for venereal diseases before sulfa drugs were powerful. It's called Salvicin 606. And it's called 606 because he got it wrong 605 times. And so you have to be prepared to recognize that you're constantly weighing the interest of the buyer and the seller. And where do you find enough liquidity, you know? And much of that is an art, but I do think there's a lot of academic work that could be done that has the element of what is science, what minimum levels of volatility. We didn't have those measures. How do you standardize it? We still have problems like with subprime loans and documentation, making sure the data is accurate, doing things like that. Very, very critical to have professional market makers and speculators. And I'll finish the long answer to that question with a thing, and everybody damns them. And you need to only pick up the paper today or yesterday and hear the president or senators, and $5 gas is a function of speculation. So I started trading in 1969. At Berkeley faculty, there was a for those of you not in the economics, there was a legendary man on the economics faculty by the name of Abel Lerner. And he wrote a book called The Economics of Control. And here I was speculating, I'm thinking, he's not going to like this at all. You know, this is not going to be. And much to my surprise, he told me that he thought speculation was very good. And I said, why? You know, do you think it's good? He said, well, we had the same problem. Franco had the same problem in the 1930s. And let me tell you how he dealt with speculation. Food prices were going up, so he called in all of the leading grain trading firms that were supposedly driving up prices, invited them to Madrid, and he shot them all. Okay? It had the desired outcome. The families had to liquidate the inventories, food prices fell, everybody was happy. Except a year later, there was drought, and there were no buffer stocks left, and famine ensued. And he said, you know, somebody's got to bear these risks over time, and, you know, speculation has a valuable function. In the commodities world, we distinguish it from gambling because there is no risk until you build a casino. There is no risk until you build the horse track. But wheat goes up or down whether or not you have the casino, okay? And the price of semiconductors goes up and down. The price of money goes up and down. The price of foreign exchange goes up or down. And the question is, who's going to bear it? And we have a well-defined private equity in this business, which everybody says is really good. You know, the inventor owns the prospect. He doesn't want to, you know, give up control of the product. He has to go to a venture capitalist, a private equity person. They take the business risk, and you get a Ricardian gains from trade.
So when listening to you talk and reading the book, I wanted to know what you guys were smoking in Berkeley and Minnesota before then, because we should all be smoking that. Because one of the cool things in the book is not only is the first framework for interest rate futures, which is then after an extensive process introduced in the 70s in Chicago, designed, one of the big innovations that Richard has, and he shows the design for this, is a for-profit trading system, a clearinghouse, for-profit exchange, which was going to be completely electronic. This was done in 1969, right? Now that's the gold standard. Now everybody is for-profit, everybody is electronic. So I want you to say something about the nature of innovative activity, right? Lots of people don't see any value in financial innovation. I do, I guess, but how do you explain to people what the value is in financial innovation? Because it's more obvious seeing innovation.
Yeah, it's a tough one. You know, everybody can say, well, I know what an iPod is, and I know what an iPad is. I kind of know what a semiconductor is. And finance is far more arcane. If you go back to slide 1 or 2, and it's for several reasons, in my opinion. There you go. Go to the one before this. The stage is set, by the way, I'm afraid, by many economists, okay? You know, Volcker thinks the only financial innovation that was good was the ATM. I think he's a fantastic central banker. I'm not sure about his knowledge of capital markets, and I think he saved America in lots of ways. Joe Stiglitz, you know, complains about complex derivatives, and certainly acid rain related bonds attached to zero coupons financed the first trade in acid rain derivatives was a complex derivative, and it was done with the city of Henderson, which I describe in the book. And that program is 1 to 3 billion in social costs and 125 billion annually in benefits. I don't know of a benefit ratio, and according to one of the more brilliant economists of our time, they're dangerous and lethal. So I think part of it, Chari, is the question that where it's many of the profession doesn't deal with the institutions and the detailed information how they do. Another one is, if you go to the next slide, if you can, everybody knows who Henry Ford is, right? You know, mass production, et cetera. Anybody in the room know who Luca Pacioli is? Anybody? Okay. If you go to the next one, he's the father of accounting, okay? Yet nobody has ever heard of this guy. Kenneth Arrow at a commodity conference said he thought the double entry bookkeeping and the limited liability corporation may have added as much value as mass production or the steam engine or any industrial invention. But how do you calculate what inventing a debit and a credit is worth? You know, it's a very, very difficult calculations. One of the pleas here is, in coming back to my alma mater, is that some economists start looking at the gains that come from social and financial innovation the same way Solow looked at it many, many years ago about the role of technology, and it's maddening to think it's no different than Jack Schmookler in the 60s could not convince many in the economics profession that we shouldn't treat inventive activity as exogenous. It had no role when I was a graduate student. It was to be considered exogenous, and it was not subject to any economic forces. And we've come a long way in the profession, but my plea is we look at these, and if I can only tell you anecdotally, I can tell you about a homeowner, I can tell you about 10-year notes which were opaque and traded over the counter, and as a result of them being traded on exchanges with bid-offer spreads, I can do bid offer thing and come up with hundreds of millions of dollars that the U.S. government saves, 5 or 6 billion a year in transaction costs that investors and pension fund managers, and the cry would be hopefully some faculty member, some PhD student, somebody will say, how can we model this and how can we derive the benefits?
I hope you guys are listening. This is a great dissertation topic. Now, part of the problem with accounting is most of us have taken one accounting class in our lives, and we viewed accounting as a huge negative in our lives. It's hard to convince people of the social value of this. Let me ask one last question, and we'll throw it open for everybody else. So I want to go to a long passion of yours, and I think lots of people, which is emissions trading, climate change, and so on, right? So pretty much every economist understands that this is an externality problem. It's not something that is going to get automatically or magically solved. It needs imaginative, collective, social thing. I want to, you should take this whichever way you want to, but one of the things that has been obsessing me a little bit, and I think you have strong opinions about this, is for most economists, taxes versus trading systems, cap and trade systems, they view this as 6 of one, half a dozen of the other, go whichever way you want to. Ever since the sulfur dioxide markets were set up in Chicago, you've been an active participant and a promoter of trading systems. Do you think trading systems are better than tax systems at curing this problem? Why? And what do you think is the future? That is, do you think that there are some young people here, whether there'll be an earth for them to inherit, whether we will be able to solve this problem? So it's an open-ended question.
A couple of just brief comments, and just for those from the economics department, those from the environmental world. The essence of trading markets was from a 1960 article by Ronald Coase on the theory of social costs, in which he suggested that bargains, that is a trade, the standard example of the railroad running through the cornfield and throwing off sparks, right? And you can command at the railroad, do it command and control, and say, okay, you can't have 5 runs a day, you can only run the train 3 times a day, and that way you'll minimize the spark flowing over. Well, Coase's argument was that there was a solution that could make the farmer and the railroad better, that they could negotiate some agreements that would make everybody better off. So in command and control, you just simply say everybody's got to cut by 10%, or more specifically, if you were running a utility, Excel, whatever it is, that these are the wrenches you have to use for your boilers. There's 10,000 pages of an operating manual to minimize pollution. Or you can say cut it by 10%, and then if somebody has got a comparative advantage and can efficiently cut by more than 10%, we have different cost functions for cutting pollution, then theoretically, and it turns out practically, that those people who can cut more efficiently will do so and sell to somebody like me who might not have acreage. I can't build the plant. It's going to take me 4 years to install the technology, that I can keep my power generator open and buy cherries cuts. So, now theoretically, in a very, very theoretical world, taxes and trading ought to provide the same incentives. But this is where I would appeal to institutions. In the early 50s, we went to war in Korea, and we didn't realize what would happen when our troops went over there, and we thought, well, it's in Asia, so it's warm, right? And Korea is brutally cold, so we decided to subsidize alpaca. Okay, and so the troops would have warm clothing when MacArthur led them. And In fact, the subsidies went on in something like 53. They came off in 54, or the war ended in 54. The alpaca subsidies weren't removed until, anybody? The 90s, okay, about 50, 45 years. The Kennedys had a big difference with Castro, and so we subsidized sugar and ruined the Everglades with all kinds of nitrogen. And we haven't been at war with Cuba. The Bay of Pigs was in 63. Okay. And it is 50 years later, we are still subsidizing sugar when the technology from beets, from high fructose corn syrup, and you can't break that. So I am struck by the complexity of taxes, and I'm very cynical after traveling to Washington over the years. Can you go to the end? Last slide, maybe. Bear with me, and I think this will be a good answer to. Keep going, one more. Keep going. Whoops, no, back a couple now, sorry. 45A it should be. 45, next one? No? Next one, please. Here you go. So the Constitution was 6 pages, okay? The Federal Reserve was 25 pages. Dodd-Frank is 2,100 pages. It's longer than the Quran, the New Testament, and the Old Testament combined. Now, if you can't more efficiently regulate the financial service industry, you can govern the lives and morals of 3 billion people on the planet, but a bill to regulate the financial sector is large. What is in there, I do not know, and I suspect only a few investment and commercial banks and some vested interests it's gotten out of hand. I mean, if you take a look at 15 pages of the Clean Air Act were to SO2 trading. 15. We've got 2,100 pages. Waxman-Markey was 1,300. And the problem that I essentially have, while it's theoretically true, I think we've got a very, very difficult situation in regard to whatever we do in Washington, be it a tax, a subsidy, where the fund's going, and who gets it. Somebody asked me, I'll conclude, what I thought the debt ceiling would be resolved. And I said, within 2 hours of a U.S. default. And they said, you're very cynical. I said, no, this is an informed opinion, because for 2 hours is not enough billable hours. Okay, between the campaign organizations, the lobbyists, and the corporations. You can't say, I'll get it done for you with only 2 hours left. And there's not enough money for the people who are getting it done for you to really have it. So you can expect decisions to be based on not what we would call rational, but it's quite rational. I mean, it maximizes the revenue flow. Washington, D.C., 2 months ago surpassed Silicon Valley as the highest per capita income in America. $84,000 a person. Now, just think of that. And I grew up, and I went to the hockey games at the U. I went to the football games. I loved basketball. I went to those. I never saw a case, and I followed the amateurs that left, and they went into pro ball, and they did well. And I never have followed a sport where the referees are paid more than the players. Okay? There's something that strikes me as odd about that, and so that's my cynicism.
I do find it interesting that Senator Christopher Dodd and Congressman Barney Frank, after having written their magnum opus, which I'm sure they haven't read, promptly retired from. Anyway, why don't we throw it open for questions? Why don't you say a question, then for the videographer, I'll repeat it, and then, any question?
Earlier, your definition of a bad derivative was sort of a, I guess you'd call it a post hoc definition. You're looking at CDS as an example. Can you maybe elaborate on that, or what are the characteristics that might, I don't know, bring to attention the possibility that we're looking at a bad derivative?
Yeah, they're not.
Let me just repeat the question. So could you elaborate on the characteristics of a bad derivative?
Yeah, it is one in which there's no risk management between the buyer and seller, okay, and therefore facilitates default and obligations, okay? So that's a if there's risk management and margining, you can deal with that. So I worked on something that failed miserably, which I do think, and I'll get to that before we finish, will be where the next disaster comes from. In trying to do catastrophic hurricane and earthquake futures. Now, we margined those. You can say anybody could be a synthetic insurer. You just say if you want to bet against a $5 billion California quake, you put up 80% of the capital in a segregated account, or you put up 20% for a Florida wind event. You don't change that until a hurricane starts on June 1st. You then raise the margins to 30 or 40% when the hurricane season begins, and then you subsequently, when you see a depression forming off the coast of Africa and moving from the coast of Africa to a beeline to Florida, you then raise it, and you raise it all the time so that there won't be a default. And so bad derivatives are ones that have no risk management between the buyer and seller, and therefore not only create private losses, but potentially create systemic losses. So that's one. The second thing is opaque. Opacity is not your friend as an economist. That things in which you cannot know the price of anything. I ask any of you, if you didn't have any idea what the price of a car was, how you would feel, or to ask you how farmers would feel about whether they should switch from soybeans to corn without knowing the prices of both of those. So price is an important signal, and if you hide it, I think that's a bad derivative, okay? It doesn't give inventors a chance to react. It doesn't give anybody a chance. So a price signal for an environmental good is valuable. It causes technology changes. It prompts inventive activity. So I think the risk management and opaqueness are, to add it, put it the other way, transparency and risk management by centrally cleared. Now, you can have risk management by a trade association, which is what the swap dealers do. But you do need risk management so that private risk doesn't become public risk.
So your remarks about opacity make me think of a slightly different market, the healthcare market. Another market where it's very hard to tell what prices are.
We started at the beginning, a pretty basic question. You know, the term derivative, I really wasn't aware of it until the 09s, 10s, when people said, yeah, it's bad derivatives because of derivatives. What's your definition of a derivative? It doesn't have to always be interest rates. I mean, an instrument that derives its value from. So can you dumb it down a little bit for me and tell me what a derivative really is and how wide is it?
Yes.
One remark for those of us in the audience. Guess who coined the term derivative? Richard did. He was the one who came up with the word derivative a long time ago.
It was in the 70s because I had to explain what was, and I'll tell you where it came from. It came from Heller-Hurwitz's class, who never taught us mathematically, but taught us about derivatives, okay? And clearly, you may remember, he didn't use calculus. He went through, and I used it in the sense that these markets were derived from okay, and were derivatives in the same sense that calculus taught us about the rate of changes of a curve and not only, its slope or, what it was. So that's it was originally meant to be something traded on a futures exchange, and it was based on an underlying and was a difference. So it had a futurity element to it. It wasn't a government bond, but it was a whole vast pool that could be delivered in satisfaction. So it differed from the actual security, and therefore an option or a futures was called a derivative. I think it got morphed, over time, and that morphing went to include anything that was either a bilateral agreement between the two of us done, or a dealer and a customer, done. And then it got in the hands of press. And I want to say to you, look, in all of the talk about the senators, the congressmen, the political process, these are fundamentally good people, okay? And they're smart people, and as much as I get frustrated, but the system doesn't provide the right incentives. And I think that's true in the media, too. We had triple witching hour, which was the expiration of stock index futures and options, and so you get somebody cleverly name something. Or in the case of junk bonds is perhaps the best example, okay? There's a financial instrument that commoditized bank credit. You wouldn't have a cell phone today if Terry McGaw hadn't gone out and raised capital. You wouldn't have cable TV if Ted Turner hadn't financed himself, and so forth and so on. And yet, basically, if you were a dealer in high credit quality bonds, okay, you had a vested interest in calling them junk, right? Because you didn't control the issuers, right? You were there financing Bill McGowan at MCI, who was taking on AT&T, and if you're lending to AT&T, you don't have any interest necessarily in facilitating Bill McGowan's $2 billion to take on AT&T.
Yeah,
So then I
bonds I want to buy.
Then I want to take a shot at the last group. So we've got the journalists, we've got the vested interest, and then we have the rating agencies. Okay, and I don't know if we've got a slide here, but it's a great slide to look at. But let me explain it because it's pretty straightforward. And I'll ask you just for your intellectual and your gut reaction to the following statement. There are only 4 companies in America that are rated AAA. Okay? Yes, left. There are 14 countries that are rated AAA. How many derivative securities do you think S&P and Moody's rated in 2000 to 2008? I will, because the answer is so preposterous. It's 16,900, in which the person who is issuing pays the rating. This is like kind of the Inquisition, you're the judge, the accuser, and the jury, I mean, the system leaves something to be desired when you can rate 16,900 securities, complex, as AAA, and you can only find 4 companies. Doesn't that strike anybody as odd, that...
It's a question back there.
And again, it's not to take shots at any of these people. They work hard. They try to do their job. There's misconceptions. They're not transparent. You get a one-time issuance. You throw it into a thing. somebody says it's, even though everything in the disclosure said this is not a forecast of credit, everybody assumed because they have to check the boxes, including the state teachers fund here, they need to go by certain rules, which then preclude good judgment.
Professor, what goes through your mind when you see these mass, people selling, helping people trade options like on these big forums? What do you think about that?
Just repeat the question. What do you think when you see lots of people making weird facial gestures and wiggling with their fingers on open outcry markets, all in a apparent frenzy?
Well, it's kind of fun. It's kind of a performance art. If you are a follower of modern art, some of these things were very, very interesting. So, for example, there was a big battle on the floor of one of the exchanges because these markets are gender biased, right? Because they are screaming and yelling and whatnot. And so women, on a statistical basis, are shorter. So some of the smart young women who came into the financial futures opened up the way for women to get into the business because it was different and nobody had a vested interest, so that they would buy seats and trade on the floor. So one very clever gal got about 6-foot-high heels so she could be better seen. So the exchange board debated the size of heels that could be. The people who went on vacation, and a lot of people took opera lessons at the Chicago Board of Trade and would scream on vacations to strengthen their vocal cords. This was great theater, but not the most efficient. It was great because it brought hundreds of buyers and sellers together in one space. But that was before there was a virtual world. And now they can meet in cyberspace, and hundreds of thousands of them could meet. And you don't have to have a physical presence and be stronger or bigger.
So Richard is responsible for the demise of entertainment in Chicago.
Yeah, it's
Chris.
Do you ever think we'll see the success of derivatives on the consumer level, like the ability for me to buy a future on the future salaries path of economists, or my zip code's real estate?
Chris Phelan wants to ensure his wage path. Trust me, Chris, the dean ain't giving you any raises. No point doing that. But suppose that Chris was in a more volatile profession. What about individually tailored insurance contracts? Are those in the future?
I don't see it at this point because the wholesalers, have been able to bundle it in such a way to protect the retail consumer. So, there are intermediaries that should be packaging the risk and reducing it at the wholesale level so that you can get it at the retail. Is it always done? No. Is there an opportunity? Yes, but I worry that the nature of leverage, that they come in and become speculative vehicles, and not that I'm against speculation, but they really don't, we call that in the business a Texas hedge, okay? Yeah. And that's where you buy something, and then instead of selling something against it as a hedge, you buy a little more, okay? And that's called a Texas hedge, as opposed to a Minnesota or an Illinois hedge, where if you're a farmer, you sell corn futures to protect you against your corn. Well, in Texas, you buy corn, and then you buy corn futures to kind of hedge your risk. So I would say no, that I don't think it's likely, but I do think that the way mortgage bankers will now hold a price for 30 or 60 days for you, that's in effect like you doing it, right? You go into a loan now, they'll give you a fixed price for 30 to 60 days. And why? because they've got it hedged, so they can give you. So it's delivered to you in a form that you don't see, but it's nevertheless the mechanisms. It's, again, nobody knows Luca Pacioli, or if they do in the audience, they think he played a major role in Godfather 1. And so these things get buried in wholesale mechanisms. Their inventors get buried. And every now and then somebody says, rightfully so, asks the right question, which is, why not a retail product? And that's because it is in many instances already a retail level.
Ask one last question from the audience. Yes, go ahead.
What do you think behavioral finance fits into the derivatives complex? I mean, do you think behavioral finance is significantly a part of the decision-making process for any type of derivatives?
Yeah, I think it's a real bright thing in economics. I want to say that it's really interesting because that's only one aspect to it, and I want to, kind of conclude on a few observations, and that if I can take that question. We formed a cap and trade system in Chicago, okay, and I don't know, and we managed to get 450 members, 700 million tons. Economics would suggest, like the lighthouse, that there'd be no reason anybody would ever enter into a binding commercial contract to reduce emissions. Well, we got them. It was experimental economics, in fact. It was just a $50 million experiment. It was a massive experiment, and it worked. Our emitters cut emissions by 400 million tons bigger than France, okay? And so we appealed to sort of the anticipation of regulation. We appealed to the fact that if you acted early, you'd gain a competitive advantage. That's why Ford Motor Company joined, and IBM, and Intel, and Honeywell, and here in this state, the University of Minnesota, that actually made $750,000 by managing its energy usage, just because the price was there. So I think behavioral finance and a look at the way people make decisions is critical. I think experimental economics is very critical, and that there are some bad things. And I want to divert from the last question to mention two things that are kind of a bit of a footnote. It's really strange. We've taken, in my case, doing behavioral finance and doing experimental economics as opposed to writing about it. We have, in the United States, gone to command and control as our basic policy tool. This is where we are. I formed an exchange in China. My partner was the largest company actually in the world, CNPC, known as PetroChina, on the New York Stock Exchange. And we formed a Tianjin Climate Exchange, and China now has 5 cities and 2 provinces that are likely to begin emissions trading. In the United States, we've completely dumped it. India announced a month ago that 3 provinces will do it, and Rio has decided to do it statewide. So all of the BRIC companies are embracing markets, and we're going the opposite way, okay? That we are seeking mandated solutions, command and control prescriptions for our issues. Then one second thing is, where are the problems? And I'm going to give you, and suppose I said to you, and there's a hint of it through the talk, hurricanes, etc. The amount of risk capital in the entire insurance industry in the United States is, I'll be generous and won't count their liabilities, is $500 billion.
Is that it?
So look at Katrina, look at Fukushima, And why? Because there's no risk-based capital in there. I can go and write against highly remote events and segregate 2 or 3 or 5%. How can you have a $15, $16 trillion economy with probably 50 trillion in assets, most of it strung along high-risk areas in the West Coast quake, in the Gulf, and up the Atlantic seaboard, all of the wealth creation that's gone on there, and you've got 500 billion. And if one event like Fukushima can knock out 300 billion, and Katrina can knock out, the answer is you're going to create, one day we're going to get a whopper, and it's going to be like banking. And nobody's looking at it because there is a basic fundamental difference between the political cycle of 2 to 6 years and the catastrophe cycle. And so if you're elected for 2 years, you don't worry about 1 in 100-year events, particularly if they're going to cost the taxpayer extra money. And so I think we're looking at here, if we were to say, let's this auditorium form a company, here's the optimum business strategy. We go to California, and we go to Florida, and we go to North Carolina, and we write as much high-risk product as we can until we run into a capital requirement. Okay? Then you got a free put to the government of North Carolina, to Florida, because you think that Florida is really going to allow the insurance business, the people who lost their homes, to go under? No. Now, if Florida does that, what happens to the municipal bond market? I mean, just think of the financial crisis that we've had, and again, there's no risk-managed capital. Now, the alternative is something called reinsurance. So the amount of hedging capital is $50 billion. Maybe if you take Lloyd's, it's 75. So you got $500 billion of risk. You almost had a hurricane in New York 2 years ago that would have taken down the entire capital in the insurance business. And again, it's regulated by states. It poses enormous systemic risk. 2 years ago, Florida had $13 million in cash in its hurricane fund. You know, so we've managed not to look at the institutions, and if this is a plea, I think somebody's got a PhD dissertation of great value to take a look at what the risk-adjusted capital would have to be in the United States to reflect the catastrophic risk.
So AIG becomes OMG. Oh my God.
Yeah.
That's what it seems to be. So this has been great. We're going to continue. We have a small reception. And so Richard will be here to sign the book. I urge you all to read it. It is available at the bookstore, but you need your own copy.
Let me say, Chari, you've been more than generous to me. I just want to say it's a very sentimental point for me to be back in Minnesota. Every dream that I ever had and everything I hoped for my wife and my kids came true because of the education I got here. So thank you all very, very much.
Thank you, Richard. I want all of you to think, so when I think of Richard, what do I think of? An economist, a friend, I hope
yes.
I can say that, a New Yorker who has become firmly attached to the Midwest, a great supporter of Minnesota, and most of all, one of the great financial innovators of our time. Thank you, Richard.
Thank you very much. Thank you.